I look after a firm called AJ Capital. We're a single family office and investor in both public and private markets. The other hat I wear is as founder and chairman of a company called Symbo, which has become a rapidly growing distribution business for insurance in India and more recently licensed in Singapore. We distribute all lines of business there, so commercial, personal lines, life insurance, general insurance, and reinsurance, all of course enabled by technology. And in India, we have a network now of about 32,000 agents who are empowered by our technology to sell all lines of insurance, as well as ecosystem partners, which could be likened most to the Zongan model, which is where we sell context-based policies to the tune of about 100,000 policies a month through that channel alone for things as varied as spectacles, fitness, bus tickets. It just depends on the partner's business.
Interesting. Actually, so I want to come back to the Zongan model that you referenced there in a little bit. I mean, for those who don't know, Zongan being one of the biggest mainland Chinese Insurtech companies, started with a very wide range of non-traditional insurance products, but in fact has internationalized quite a bit. They have a strong presence here in Hong Kong and Singapore, but in fact most recently have been granted a digital bank license here in Hong Kong. So an interesting example of an Insurtech kind of moving laterally into other areas of financial services, which again is a neat transition into our second guest here, Walter. Walter, introduction please, and a little bit of background about Singlife.
Sure. Hi, I'm Walter, CEO of Singlife. Singlife is a fully digital or Insurtech-based life insurance company in Singapore. We started in about 2017 when we got licensed and funded, and have built out a really cool niche life insurance company. When we started was we thought, well, the insurance industry was not particularly sexy, and we thought we could build a better kind of life insurance company if we tried, and so we just did. We've had fantastic support from our regulatory framework in building out an insurance or life insurance proposition. And we've been growing from strength to strength over the last couple of years. We started out purely doing life insurance, critical illness type of covers online, both direct to customers and via financial advisors. And more broadly now have expanded into the cash management or savings space, and having been licensed as a Visa issuer and attaching that to insurance-backed solutions as we take on the broader financial services industry.
Yeah, and I definitely want to come back to that, Walter. I think some super interesting stuff you guys have been doing on that transition from insurance to other FS. By the way, I can't see your shirt, but based on that red, I assume you're wearing the company colors. There we go, Singlife. Never missing a chance to promote. Good to see.
Work from home,
Jonathan.
man.
Jonathan, good of you to rejoin us. You're keeping us in suspense there, but maybe a quick introduction to yourself and Ping An, of course. I think most people should know Ping An, but maybe for those who do not, and then also the Global Voyager Fund, which you lead.
Excellent. Let me just double check that you can hear me, since
I can hear you loud and clear.
Sorry about that. Good. So Jonathan Larsen, I'm the Chief Innovation Officer for Ping An Group. And I am the CEO of something we call the Ping An Global Voyager Fund. So Ping An is, by some measures, the largest insurance company in the world, certainly by market cap, and is certainly the largest player in the China insurance market. And probably most people would know Ping An has a very wide range of financial businesses, but has been a leader in building out FinTech platforms, and has in many ways transformed itself into a technology-first company. We have a wide ecosystem of health businesses alongside our financial businesses. Some of the financial companies and health companies that people might be aware of that Ping An has created include Lufax, Ping An Good Doctor, which is the largest telemedicine platform in the world, and one of the businesses that we recently listed was Ping An One Connect, which is a enterprise financial and fintech services platform that we just listed in New York in December. And the Global Voyager Fund is our group corporate venture capital arm. So what we're interested in doing is finding and investing in companies that can be additive from a capabilities perspective to Ping An, That can either mean taking something that is complementary or additive to our own internal R&D efforts and creating some partnership whereby we can bring a technology, a business model, or a platform into China. Or it could be a company that, excuse me, has a platform outside of China where we can actually bring some of our technology to bear. So far, we're a $1 billion fund in terms of committed capital. We've deployed about $250 million so far. Our typical investment is in the sort of $15 to $35 million range. We're typically looking for a non-controlled stake of 10 to 20% in a company. Some examples of companies that we've invested in recently are iCapital in New York, which is the largest alternatives administration, delivery, and due diligence platform for hedge funds and private equity firms distributing through wealth management firms in the world today. H2O.
I think I'm assuming we're all losing Jonathan as opposed to myself. Okay. Yeah. So again, the show must go on while Jonathan seeks to rejoin. I think maybe AJ, let's come back to you on the investment thesis, and when Jonathan comes back, I'll bring him back in on this. From an investment perspective, how have you seen things change in the past, 2 months as a very direct consequence of COVID-19? You mentioned before through the family office you've been investing in this space.
Yeah.
Maybe thinking about early stage companies and growth stage, apart from the kind of obvious truisms around cash is king and build out sustainability. Has there been a specific consequence for insurance related companies or kind of how do you see that?
So I think there's an acceleration of the trend that we saw in Q4. Q4 was one of the largest amounts of capital committed to Insurtech historically. We saw about $2 billion go in to Insurtech companies in Q4 of 2019. The other interesting phenomenon that occurred was there was a large rise in the number of companies raising $30 to $40 million. And it was much less by way of capital going to early stage businesses, which were trying to raise, let's say, a few $100,000 or a few single-digit $1 million. I think this has simply exacerbated that move. So people who have early stage businesses who needed time to establish their business models are going to struggle. Our business, Symbo, is a young business, but it's Series A, and we closed that round, fortunately, in December. So we have the runway that we need to make it through to the other side of what will hopefully not be longer than 18 months of pain for the early stage community. But it is a challenging time for early stage businesses. And as you said, there's an obvious push to sustainability and cash. But I think from the perspective of the early stage ecosystem, and we typically, even on the investment side, wouldn't go beyond a Series A, maybe a really great Series B business. I think the seed and Series A type businesses are going to struggle to get funded or have to really reevaluate, why they believe they deserve certain valuations. So we expect that trend to continue.
Jonathan, good to have you back. I'll come to you in a moment, but I just wanted to check in with Walter then. Specifically, Walter, maybe, you mentioned in terms of what Singlife, started out from a life insurance perspective, you've been kind of moving laterally to encompass other areas of the kind of fintech space. In terms of your own fundraising journey, like just staying on the investment theme for a second, in terms of your own fundraising journey, I can't recall when last you closed, but you guys have raised a bunch of cash. It's been an interesting success story. How do you now see the market? If you had to go out cap in hand today, how do you think that's looking from an early to growth stage perspective?
Well, Singlife has been very fortunate along the way. We've never actually ever gone out with a formal fundraising cap in hand approach. We've never run a series or anything like that. What we've done is we started the business with 2 supporting shareholders, and then as we've progressed, more and more interest approached us along the way to say, we love what you're doing. How do we be involved? And subsequently, we've included more and more shareholders at the table. The most recent being Sumitomo Life, who invested $90 million in both primary and secondaries in about June of 2019. So we're sitting in a position quite neatly now with enough cash to be able to continue to grow the business. Our issue now is, as a life insurance company, we're not actually, the money is not being spent on building business as much as having the regulatory capital to keep growing. Life insurance is a capital consuming business, and we will constantly need to increase our capital base as a result of our success rather than as a need to constantly reinvest in the business. What we did with our capital base in the beginning was we wanted to try and balance it very neatly with an amount of or a balance between the aggressive venture type of investor or funds-based investor and the more longer-term strategic guys, so that there was always a balance, so that in the hard times like now, I know that when the time comes that we need to raise additional capital because we are growing so well, that capital us because we have shareholders with very deep pockets who are able to provide that and continue to see the long-term outlooks of what we're trying to do. But that story is very different for other people that I see in the market. As Abhinav said, the other Insurtechs in the market are really, really struggling, and right now it would be very difficult for anybody who is looking for the 1 to 5 million capital raise to find. And I think there is definitely hard times ahead for a couple of these guys.
Yeah, I mean, I want to come back to that as a group around, I think there's a lot of talk in terms of the negative impact of COVID-19, et cetera, but clearly there will also be winners, right? I mean, just as we've got winners in the telepresence space and the ed tech space and so on and so forth, I am kind of keen to understand, in the Insurtech, who do we think will benefit from this? Will the incumbents benefit in some way? Will some of the non-traditional players? But maybe just before that, Jonathan, I guess, you and I have spoken about this many times over the past number of years in terms of the valuations that some of these fintechs have been able to manufacture, if I can put it like that. Is COVID-19, is this kind of global pandemic and disruption a return to sobriety on some of the kind of more grandiose fintech valuations? Are we returning to basics now, saying, actually, you know what, things had gotten a little bit out of hand? And of course, this is not specific Insurtech or fintech. We've seen some of the big tech valuations coming out of the US and other areas have kind of come down to earth a little bit. But how have you been seeing it on the ground? $1 billion fund, very active internationally. Has there been a very material change in your eyes over the past couple of months?
I think there's a pretty fundamental change in expectations. I think sort of valuing based on hope is certainly not going to be tenable for most investors. No doubt there'll still be some people that have large amounts of cash and are keen to deploy it, and they're prepared to, value companies way ahead of their demonstrated potential, where those companies have to grow into their valuations. So I think that's not going to go away completely, but certainly we've seen a real burst of reality in the prospect that we're talking to right now. We actually have a pretty good pipeline. We tend to focus on companies that are pretty much self-sufficient already for cash, who are sort of getting close to either at break even or very close, who have a meaningful revenue stream, and who are really looking for capital to fund their next phase of growth. So, we're really a late venture, early growth stage investor. In that space, we actually see pretty good opportunities, good companies that, want that funding for the next phase of growth. And I think, I think the ones we're talking to, I think have a very realistic appreciation of where the market is at right now. I agree with the comments that Walter and AJ made, which is that, I think for companies that aren't fortunate to have done their funding round before COVID hit, if you're in an early stage, if you're in a cash-consuming stage, it's going to be a very, very difficult time. And those companies, they need to husband their cash resources as best they can. Many will need to go into hibernation mode and just bear this thing. This is going to take months and months before we get back to any semblance of normality in the economy. There will be permanent effects. I think just before we got onto the live session, Walter was saying, will you go to London or will you just do a video conference now that we can do these kind of meetings? Well, I suspect that there is a permanent change in behavior. You asked earlier about upside opportunities. So yes, there are parts of our business that have just exploded in volumes. Our Good Doctor platform is an example.
Telemedicine.
We have 300 million users in our telemedicine platform in China. No one wants to go to a hospital and sit in a waiting room with 200 people and catch each other's COVID or other diseases. So you can imagine that that business has just sort of been catapulted to the forefront of people's minds and opportunity. We're actually seeing governments in all over the world, but specifically in China and most recently in Hubei province, actually start the process of formally setting up the rules to reimburse telehealth consultations through the state health insurance system. So far, we've built Good Doctor entirely side of the reimbursement system, and we haven't received $1 single or RMB of government reimbursement. So that is about to change. That's something we've predicted for a very long time, but I think COVID will be a catalytic sort of moment in time that just transforms that digital health landscape. But we're seeing parallels emerging pretty much all over the world. And when you talk to a doctor, whether it's a specialist or a GP, most doctors will say, listen, I could do my job twice as efficiently if I could see 70, 80, 90% of my patients over video first and decide whether I need to physically see them, thereafter. But, an enormous amount of what a doctor does with a patient can be done remotely. And clearly that's more efficient for everybody. And if you can then layer in an AI triage process at the front of that, and then you can layer in remote monitoring, remote diagnostic services, and remote drug delivery, you've transformed the health system. So I think in that area, we will see this be just an enormous catalyst for a change in how the world delivers health.
And I guess maybe to the group, do we think, is it too early to tell whether there are individual markets that can get ahead of that curve? I mean, I guess, based on the folks here, Jonathan, through Ping An, and you know the mainland market well, but equally through international. AJ, you guys have a presence in Singapore and India, another just huge market where there's, an incredible amount of opportunity, frankly, as a consequence of an incredible amount of inefficiency as well. Walter, you guys are present right now in Singapore. You've got a Filipino operation up and running, I believe, and maybe some more Southeast Asia in the works. Is it, and I'm probably answering my own question, is it a bit too early to tell who are going to be the market leaders from a geographic or a country basis? Have we seen any governments or private enterprise in any of these markets really take the initiative, or is everyone still dealing with, actually the house is on fire, I better figure out how to put it out first?
I think there's a bit of house on fire everywhere, but I think there is also an immediate rejigging as people now realize this is the new norm and people just have to deal with it. You still have to go to the doctor when you people still get ordinary colds, and they get ordinary things that matter in people's health. It's not only about COVID-19, and people still need to have those accesses. I think there's going to be a bit of competition in the digital health space. I think Good Doctors is clearly a market leader in China and has made good inroads in other places, and has got great partnerships with, say, Grab and others. But there are others out there that are also vying for the space. The technology itself is not particularly difficult to replicate in that Insurtech space, and so it'll then become an outcome of the quality of service, the ease of the experience, and the advertising and push that drives behind it to gain more market share. And that'll happen in Singapore, Philippines, Malaysia, all of these places as well.
Okay. AJ, Jonathan, anything a bit too early to tell who will be a market leader in this space?
I think for telehealth, there are strong players in the US. There's a player everyone would know called Babylon in the UK, who's I think a market leader in that space. There are small players in Europe, and I don't think there are leaders elsewhere in the world yet. So I think it's a pretty open space. I think it's more about business model than technology, but I do think it's a huge area of opportunity. And I think it's going to be interesting to see whether any big payers are adroit enough to be able to pivot themselves into this space over the next year or so. I think probably for incumbent insurers and for all incumbent financial institutions, there's a sharp awareness now of which parts of their business are really functioning digitally and which aren't. Everybody has a digital overlay for everything, but then you find that the digital overlay only does 70 to 80% of the job, and the customer still needs to talk to somebody, come to a physical location, or heaven forbid, send a fax. I'm not joking. So I think in this conference, Vishal Garg from Better Mortgage was talking probably earlier today, US time, and Better is one of our portfolio companies, and they're really the only full stack end-to-end digital mortgage player in the US. And when you contrast what they do versus the big banks, who have a half manual, half automated process, and especially when they've got people working from home, the process just doesn't work. So when you've got thousands of refis coming in the door, they just can't process them. Better can. That's the difference. So I think people are going to have this very sharp distinction between what's working and what's not working within their digital delivery. And I think there'll be a real focus on retooling and accelerating, which frankly is not before time.
Bringing it back a little bit into the Insurtech space a little bit. We've all got friends in the FinTech community. A lot of the talk and chatter has always been around payments and digital banking and all of those much more sexy things than insurance. But I think that what we'll see with the next 6 to 9 months is that the focus will shift a little bit away, because I think the payments infrastructure players, the transaction revenue sourced technology companies are all going to suffer a lot over the next while, because transaction volumes is just going to go down, and every forecast that anybody's made around that is wrong. So those companies are going to struggle. I think that human behavior is leaning much more in the favor of the insurance industry compared to the traditional financial services industry. And that's purely because at times of difficulty, people are always looking for safety. We've seen it in time and time again. Insurance businesses that I work in global financial crisis on the life insurance side, we've done phenomenally well when markets are dislocated, because people tend to move towards places of safety. This will affect both our general insurance stuff and our life insurance stuff. I think the general insurance might be less so, because less car consumption, less travel, less motor pieces, but that'll have a downward. It'll be good for pricing, and lower accidents means that more profitability in the car insurance market. Health insurance is a great one. People don't go to the hospital anymore, so we're going to be seeing great proper profitability coming through on the insurance sector on the health side. But where we've been focusing much more is that we believe there is a huge attractiveness of a safe place to put your money. We will see that the financial services system there'll be very strong downward pressure on returns and rates. But I think there is an opportunity, given the way insurance companies work, that we can offer better returns to customers, given the way in which we're enabled to invest customers' money. And I think that will suit the Insurtech business very well over the next 6 to 9 months.
So I guess maybe, and AJ, this is one for you as well. Is there a bit of a rising tide lifts all boats here? Because Jonathan was mentioning earlier, I think it's true in insurance as it is in banking and elsewhere. A lot of the fundamentals they're realizing had a kind of a digitization component, but end to end, there's still quite a lot of gaps. I mean, COVID-19, if nothing else, will have quite starkly exposed those gaps, thereby kind of greatly incentivizing all players in the insurance or banking space to kind of try and patch those holes. So, the incumbents will respond. I mean, the big insurance players, reinsurance, whatever else, is that an opportunity for service providers? Is that an opportunity for Insurtechs, or does it actually begin to close out some of the white space that new players would otherwise have entered? Maybe AJ, given your position.
So, couple of comments on that. So one is that in our view, especially because we're a distributor, it makes sense for us to partner with incumbents who have large and growing books of business in general. So not just for distributing product, but more recently, and it's exacerbated by COVID, the fact that our technology is so much more rapid in its ability to fulfill the distribution as well as the account management process. So for example, if we want to sell a car insurance policy, our agents can, using our app, do it in 2 minutes versus a few hours or a few days if you had to go back and forth with the insurance company in the standard process. we've been pitching this forever to incumbents that they should license this technology from us, but we're seeing for the first time that there's momentum in those conversations, and we're actually on the verge of signing transactions where people are licensing our platform as a service, right?
Okay,
and that
so yeah,
it's not our core business because it's not our core transaction of monetizing the sale of insurance, but at the same time we like it because it is minimal customization. We already have APIs into every single insurer there is. So it's more about turning stuff off and throwing a skin on the product than actually turning stuff on and redoing the product, right? So it's gross margin accretive, it's low on effort, and we're having more and more of those conversations, at least with our partners in India. So it's, from a trend perspective, I think that will be that'll be something that continues, because once that change happens and the insurers do switch to these models for whether it's distribution or operations or claims, there's no incentive for them to go back. What I'm concerned about is more the demand side, because in markets like India, where there's a certain type of customer from a demographic perspective who can afford insurance or is maybe insurance aware, that customer is currently going to be concerned about their earning capability, right? So while I very much agree with Walter about them wanting to focus on their savings, but there are going to be layoffs, there are going to be massive cost reduction exercises across the board in the months to come. And so we are going to see some reticence on the part of folks to spend on certain types of insurance.
Yeah, I think it's just worth being just sober about this. There's going to be huge economic fallout, and that fallout will impact different segments of the population unevenly. And clearly, for those people who are close to the edge in terms of cash flow, creditworthiness, and frankly employment, the ability to muster discretionary spending, let alone saving, is going to be just about zero.
Exactly.
And with the types of sort of economic contraction we're likely to see in the second and third quarters this year globally, it's going to be a very, very ugly environment. I actually think all of this speaks to a strengthening of incumbents. I totally agree with Walter. There will be a flight to quality. I think many incumbent businesses, particularly insurance, will benefit on the claim side. There's going to be it's going to be very, very tough for B2C companies to break in. They're not going to have the resources to do it, and the consumers aren't going to be there. And I think there is this imperative for incumbents to retool using digital infrastructure. So I think from a FinTech perspective, much of the opportunity will be infrastructure plays and providing the componentry that allows the new digital architecture to actually be implemented within the existing industry to a large extent.
So let me.
There won't be plays outside of that, but I think that will be a big thing.
Well, let me ask you, Jonathan. Given that China, mainland China, has been the kind of canary in the coal mine on this. Maybe the bat in the coal mine would be a more specific. But China has been coming back. Pretty. Well, it appears that China has been coming back quite effectively over the past couple of weeks. Hubei province has been opened up, Wuhan. I mean, I guess a macro question here: how much have you seen through your role as CIO at Ping An, from a mainland perspective? How much have you seen of an impact just in China itself? And then looking forward, is this something that all businesses in insurance and other industries will need to bake in? I mean, do we need to build in resilience to the next COVID or the next coronavirus or the next global pandemic? I mean, I'm curious how much, in 3 months or 6 months, things kind of return to normal, or is preparing for this type of eventuality part of the new normal?
Things are getting back in China, but it's going to be a long time. So it's going to be a long time before schools are open, universities are open, the healthcare system is functioning as normal. There's people are going back to restaurants in big cities, but many businesses are still closed. Many people are still working from home, so it's going to be a slow process. I think the China macro numbers, we'll have to see over time. I doubt whether the numbers that have been released so far really reflect the full extent of this thing. Certainly from a business perspective, any business that involves face-to-face contact, and one part of the insurance business, those that depend on agents, clearly feel a substantial effect, and we're no exception there.
How many agents? Remind us of how many agents Ping An have. I mean, it's some incredible number.
We have 1.3 million agents. So obviously, and we have a lot of digital tools, and those agents are interacting with their customers remotely. They're finding ways to get business done, but it's clearly very difficult relative to the days when you can simply arrange a meeting with the customer. The other piece that's going to flow through, and we don't know the extent of this yet, is consumer credit. This is going to be global, but in China, clearly we're seeing consumer credit impacted by this. I think with the unemployment numbers in the US right now, there's going to be a very, very significant wave of consumer credit defaults. No doubt there will be government-led relief programs in most markets to try and help consumers and soften the blow. And if this thing proves to be a V shape and people get back to work and are able to restore their repayment capability, maybe that helps. But there's going to be substantial fallout there as well. So that's certainly something that's evident in China right now. And of course, this is where when the water goes down, you see who's wearing bathers. So the people that have really robust credit processes and policies and focusing on quality customers, those guys are probably going to be fine through the cycle. For the people that aren't, it's going to be more difficult.
Okay, guys. So I think we're kind of coming up on time. So maybe I can finish by asking each of you individually. If we're sitting here again, well, let's hope there isn't a quarantine summit needed 12 months from now. But maybe we can all get a chance to meet in person again. But 12 months from now, in the insurance and Insurtech sector, or broader FinTech, if you prefer, what do we think the biggest changes will have been 12 months from now, and who do we think the biggest winners will be? Maybe AJ, can we start with you? Go to Walter, go to Jonathan.
Yeah, so I think there'll be a dramatically lower number of companies that call themselves Insurtech, either because they've pivoted away or they're no longer around. As one of the reports I was reading called it, there'll be infant mortality in the Insurtech space for some of the younger stage businesses that were just about to get started. In terms of who the winners will be, I very much believe that the incumbents actually are going to do fairly well, the large insurers and reinsurers, because of the fact that they will, instead of, as Jonathan called it, a digital overlay, they will become truly digital in several aspects of their business. They will learn new things. Like we're seeing, we have our agent network of 32,000. A lot of them are happy just transacting with their customers on WhatsApp. They don't actually need to meet them. So that in itself, and this is stuff which people believed they needed to do, but now they realize that they don't need to do. And so, behavior in terms of the distribution journey, as well as digitization of the internal stack for the insurers, especially on the distribution side and on the claims handling side. So we believe that people with large books of business who will have this period of profitability due to lower claims, as Walter said, and also because of the fact that they'll become digital, there'll be substantial cost savings on the operational side. So our money's on the incumbents, and we want to partner with them in that journey.
Interesting, Walter. As a challenger to the incumbents, where do you see yourself and the kind of wider industry in 12 months as a consequence of this?
Somebody who's raised a couple $100 million challenger anymore?
Yeah, are you a startup still, Walter? I'm not sure. Depending on who you're talking to, maybe.
But our view is pretty simple. The best technology or FinTech or Insurtech is only as good as your ability to build a product that you can distribute. You can build the coolest tech in the whole world, but if you can't distribute it, it's meaningless, right? So the question is not so much about Insurtech, it's more about what is the distribution mechanism going to be for putting that tech to use. I think for those Insurtechs that were building componentry for the benefit of the incumbent insurance industry, I think that they will all be gone because the incumbents will worry about their own distribution in the short term. I think, as you say, agency is a very, very difficult type of business in the current climate. I think yes, they're all happy to go to their WhatsApps and stuff, but what happens when they've run out of customers? Yeah. What happens when they gone through their entire list? So my view on the insurance and insurance distribution space is that the winners will be those that are going to be able to transcend distribution mechanic away from an incumbent mechanism. And I think that there are very, very strong stories available for those that can leverage what types of things people listen to. And people listen to social media, and people listen to their friends, and people listen to the news. And if you can find ways to access customers in those ways, Insurtechs will win. And if you're going to just build cool tech and hope that someone's going to integrate it into their system, you will lose. That's my view. And I really, really hope Singlife will win.
I'm sure we can all agree on that, Walter. So, Jonathan, final thoughts, 30 seconds. Winners 12 months from now.
So I think that it's got actually nothing much to do with technology. We've had the technology to digitize insurance, in fact, all of finance for at least a decade, with the current distributed mobile platform that we all understand. So it's not about technology. The technology is already there. It's been there for a long time. I think that the real change will be behavior, and adoption, user adoption, and people's mindsets about exactly how they can interact with financial institutions and what they can get done remotely versus what they need to get done in person. That is going to be the big change from this thing. And the longer COVID remains, the bigger and more fundamental that change will be. And I think that is going to be an enormous opportunity for those players that have the wherewithal. It will not be all. There will be, and I think it will overwhelmingly be incumbents, but there'll be haves and have-nots within the incumbents. There'll be a small number that get it and can pivot quickly, and there'll be quite a few that get left behind. So that's what I think will come out of this thing. And I think there will certainly be a flushing out, within the entrepreneurial sector. No doubt about that whatsoever.
Excellent. Okay, gentlemen, thank you for your time. I think we're going to leave it there. As I said, hopefully 12 months from now, we'll be meeting in person again, whether in Hong Kong, Singapore, or elsewhere. But in the meantime, thank you very much for your time, AJ, Walter, and Jonathan, and to the organizers of Quarantine Summit. Thank you, and I will see you soon. Cheers. Bye-bye.
Bye-bye. Thank you.